Hi, I'm Scott Robinson, Director of the REIT Center at NYU Schack Institute of Real Estate. I am fortunate to be co-hosting our fall REIT leadership series with my friend and industry colleague, Robin Panofka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute, notably as conference chairs of our annual REIT symposium held every spring in New York City. Today's conversation with Lisa Palmer, President and CEO of Regency Centers. Lisa joined Regency back in 1996 and advanced through the management ranks to become CFO in 2013 and CEO in 2020. She has navigated Regency through the pandemic, and I'm very appreciative for her sharing her time and insight with us today, as well as providing career guidance for our students. I also want to thank the many NYU Schack students who participated in this series, including today's co-host, Gisela Hadar.
All right, so we are thrilled to have with us today Lisa Palmer, who is the President and CEO of Regency Centers, an S&P 500 REIT with about a 15 billion market cap, 400 plus neighborhood and community shopping centers. And Lisa is also the incoming chair of NAREIT starting in January. So welcome, Lisa.
Thank you. I actually started last week.
Oh, great. Congratulations.
At the annual conference, yes. So the torch was handed from Marguerite Nader over to me last week in San Francisco.
Superb, superb. So why don't we start a little bit with the big picture, both wearing your CEO hat at Regency and your new NAREIT hat for the whole REIT industry. You went through COVID at Regency, fared really well for a retail REIT. Dividends were maintained throughout, and you've come out 95% occupied. Tell us a little bit about how you managed that and how you're thinking about next year, both for Regency and the industry, given interest rates, inflation, tech changes, Ukraine, all of that.
Yes, first, thank you for inviting me to do this. I appreciate it. I love working with young adults. I think it's fun and a way to actually make it an impact, and go and reach kind of further from what we do in business. So most of my comments say, while I am now officially chair of NAREIT and I do have some visibility into other sectors, most of my comments probably will be much more related to retail, just because of what I know so well, and my knowledge of multifamily and office and self-storage is going to be very similar to all of yours. It's what I read in the newspapers and analyst reports. But generally speaking, and I think this is true for all companies in and outside of the real estate industry, we like to say that when COVID hit, we were literally learning how to fly while we were flying the airplane. There's just no precedent for what was happening to all of us, personally and professionally. And so there's therefore really no playbook. And we really tried to figure it out as we went. And the thing that we tried to do at Regency to guide us was really just stay true to our values. And so as we made decisions, we thought about our values and what does that mean? And at Regency, we certainly are we're always very open, very transparent. And we also always try to do the right thing. And so as we approached COVID and not really knowing what this meant and winding the clock back to April of 2020, I still remember, I don't know how many of you all would remember, but we are a shopping center company that owns 400 plus shopping centers across the US. In Seattle, we have a pretty large portfolio. If you may remember, it's where it started. So from Seattle down to San Diego, go across the bottom of the country to Florida and up to Boston and across to Chicago and Denver. We only collected 42% exactly of our rent in April of 2020. Yet all of our shopping centers were open because we have primarily grocery anchored shopping centers. So our expenses are more or less fixed. And we couldn't cut our operating costs, but we were only collecting 42% of our revenues. So there was some really long discussions and nights about whether we would be able to continue to, and how long could we continue with that.
And keep the dividend current as well.
And we had lots of conversations with our board about that. We did end up borrowing very little money, just as a safety net. We borrowed $10 million off of our line. We have a $1.2 billion credit facility that was undrawn. So we had a lot of liquidity to access. And we never thought that there was going to be the financial liquidity crisis like there was in the GFC. So we weren't as worried about the banks being able to fund our facility if we needed to draw upon it. So we really took the $10 million as an insurance policy. Hindsight, we didn't need it. So that was very early. So what we learned through COVID and how we fared is, again, open communication with our tenants, supporting them. I think one thing, again, from the retail perspective, if you think about shopping centers, so we own, I said, approximately 400 plus shopping centers across the US, mostly grocery anchored. So it's 80% plus grocery anchored. The rest of our shopping center, in some cases, will have secondary anchors, is what we call them. So, you know, the TJ Maxx's of the world, or Ross Dress, you know, Bed Bath, those types, but very few of those. Most of what we have are what we call small shops. And while they may be national, QSRs, quick service restaurants like Chipotle, some of the sandwich shops, coffee, Panera, there's a lot of mom and pops. And in the case of COVID, what we tried to remind our people that this is the livelihood of a lot of these people, even the national chains that are franchised. So they were going to try to do everything they could to figure out how to keep the business afloat. And that's what we did see throughout COVID. And it varied in different geographies because it really mattered how restricted the operators were on what they were able to do with their business. So I'm headquartered in Jacksonville, Florida. By May of 2020, Jacksonville was wide open, and our tenants were able to operate with a little bit of restriction from a distancing, but generally able to operate as they had pre-COVID. California, on the other hand, took well into 2021. And so the impacts were felt differently across the country, regardless of quality of the real estate. And all we tried to do is continue to support our tenants and let them know that, yes, we had a lease, which is a contractual obligation for them to pay us rent, but we weren't going to kick them out because this was such an unusual, unprecedented event. And fortunately, when you think again about our type of real estate, grocery anchored shopping centers, very convenience oriented, value oriented, and necessity. And so people continue to go to their local shopping centers carefully. And that was part of the thing too, is, we tried to make sure it was a safe environment. People felt safe while they were there. Lots of signage, to the extent that we could have any type of, cleaning, sanitizing that was very evident. We did that as well. And as a result, our foot traffic at our shopping centers recovered pretty quickly. And then our tenants were able to pay rent pretty quickly. So that was sort of in the moment. When we look back, this is what we believe has changed, if you will, from our real estate perspective. So in 2018, some of you may remember or reading about, it was the retail apocalypse, and physical bricks and mortar retail was dying.
Finished, right?
That they were the headlines. Amazon e-commerce was going to eat everyone's lunch. And then COVID hit in 2020. And what happened during that time is all retailers, not just grocery stores and not just discretionary, but even restaurants that really adapted and became more innovative, realized that servicing their customers from within what we call kind of the last mile is so much less expensive. And so they were able to do that. And so Target, for example, fulfills 95% of all sales from their stores. We've had conversations with Gap. Gap tries to fulfill all of their digital orders from their stores. So doing it from centralized distribution centers is just more expensive, especially when you have to take it to someone's home. So there became this renewed appreciation for the physical presence. So that was one thing. That's the cost side. And then the consumer behavior side, people want to go out. There are, there's a select number of people that probably enjoyed COVID and not being able to leave their homes. But the vast majority of people missed human interaction and social interaction and just wanted to get out of their homes. So again, this renewed appreciation. So we've seen our retailers, again, across all categories, actually increase their, what we call the new store growth, if you will. So the open to buys is what they call it. So the demand for new stores. And then the permanent trends, there's micro migration. A lot of people leaving the inner cities and the urban cores and going to first ring suburbs as a result of not needing to go to the office 5 days a week. So having a little more, less worry about the commute time. And then because there is hybrid work and more remote work. And as you can see, I'm doing it today, work from home. When people are spending, 8 to 10 hours in their home office, they want to go out when they're finished. And where do they go? They go to their local neighborhood shopping centers for fitness classes, for restaurants. And those are real tailwinds that we are still experiencing.
Pretty amazing, really, how it kind of turned around so fast. I mean, the retail apocalypse, you're right, and everyone predicted COVID would seal that coffin, but quite the opposite. So you've mentioned a couple of times.
A different story, though, Robin. So mine is about open air shopping centers. Malls are still struggling.
Yeah. Although in Florida, does anybody care about going indoors? I mean, They don't seem to care about anything.
No. No.
So you've mentioned grocery anchored a few times, and I'd love to get a little bit granular because a lot of the questions we got from the students were about the specific business model. And looking at your website, people noted that you say you're 80% grocery anchored. Your average grocer sales are about $740 a square foot. And your average grocer occupancy cost was about 2%. Tell us a little bit about those metrics and why you think it give you a strong advantage.
Yes, so we do believe that consumers do have a choice. And when we do that, all retail is not created equally. We know that. And so when we think about what creates a successful open air shopping center, it is those daily trips. And so a grocery store is your anchor, and that's what brings people into your shopping center. And then the ability to merchandise around it, even if someone is coming in, even if they do a buy online, pick up in the parking lot, they just pull into the spot and have someone bring it out to their trunk. They're still seeing what else is there. So when you are home working 8 to 10 hours a day, and you decide that you want to go out to eat, it's the advertising was when you pulled into that parking spot to pick up your groceries, you remember seeing your local restaurants. And so it tends to just keep that behavior of behavioral shopping patterns in place. And so having a productive grocer, someone that is going to drive the traffic into your shopping center, clearly helps all those side shop retailers and anyone that is within the shopping center. And average sales of 740 with occupancy costs of 2% is just really productive. And generally speaking, I've been with the company now 26 years. Throughout every downturn, the shopping centers that tend to be the most resilient during challenging economic times were those that had highly productive grocers. And it's because of these shopping patterns of people coming into their local neighborhood center. And nobody knows the name. I know if any of you live in suburbs, nobody knows the name of their shopping center. But you call it like, I'm going to the Trader Joe's Center, or if you're in Florida, I'm going to the Public Center. Or if you live out in Long Island and East Meadow, I'm going to Stu Leonard's. So that's, and that is why that is so important. And from a occupancy cost, the grocery business is a really low margin business. Rent is actually one of their highest, believe it or not, one of their highest single line items. And yet it's only 2% of their operating it's a small percentage of their sales, 2% of their sales. So a productive grocer at 2% is really healthy. We think that some can afford, because of the low margin business, to go as high as 5%, but that's really stretching it for them. And then other types of retailers, the way it's almost how you determine what a retailer or service provider or restaurant is able to pay is based upon percentage of the traffic, the sales that they produce. Grocers are 2 to 5. Secondary anchors are going to be, 5 to low to high single digits, say 5 to 10%. And then the small shops, again, depending upon the use, anywhere from 10 to 20% of their sales.
So is part of the trick having kind of the best located and curated center? I mean, how do you ensure that you have such strong properties? And maybe talk a little bit about the acquisitions, because I noticed you're not just sitting on your 400, you're buying more. I assume maybe you're selling some, and you're redeveloping as well.
Yes. So I know everyone's heard location, 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 and that clearly is the three most important criteria for when we're looking at new real estate, if you will, new investments, because you can change the merchandising, you can't change the corner. And when we actually have built a proprietary, we call it our DNA model. So it's just a database that has so many inputs to help us in our score, if you will, what makes a successful shopping center. And the trade area, so we live in a trade area. I mean, we operate in a trade area business, not a major metro market. And our trade areas tend to be pretty small. Grocers, usually the households that shop a grocery store, depending upon how dense the area is, in places in metro New York, it's a mile because it's so dense.
Wow.
And traffic can be so bad. So the most important inputs into this proprietary model are the demographics. So the population density, and then median or average household incomes. So how much disposable income do people have to spend at their local shopping centers? So when we are looking at new investments, that is what we look for. And then another important thing is the competitive supply. So how many shopping centers, retail, how much retail is that in that same trade area? Because just like any other business, supply and demand matters. And the less supply available, the higher the rents we're going to be able to charge, because those retailers and service providers are able to generate higher sales because there are fewer options for customers. So that is what, when we think about new investments, whether it be acquisitions, even new developments, or even investing back into our existing shopping centers, we really do grade our shopping centers. And we like to say that anytime that we're going to invest new capital, it should check 3 boxes. One is it should be accretive to earnings. 2, so that means essentially the NOI, or the income that we're generating or buying, has to be greater than our cost of capital. 2 is it should be accretive to our quality. So essentially, we're not going to buy something or invest in something that's not in the top half of that wouldn't be in the top half of our shopping center in our whole portfolio, and then accretive to our future growth rate. And that's how we think about our future investments.
Very interesting. Gigi, I know you're very interested in development. Did you have some questions about that?
Yeah. Thank you, Lisa, for all that information. It's very educational. My question, I know that you guys have a strong focus on redevelopment as a company. And my question is, what is Regency's typical model for purchasing properties and redeveloping? I believe you guys have right now budgeted about $150 million for redevelopment. So I was wondering if you can speak a little bit about that, and specifically how you look at going about redevelopment, of the shopping centers.
Yes, of course. So I like to development and redevelopment. So it's not just redevelopment of our own properties, or even, again, we just recently acquired a shopping center on Long Island in East Meadow, Aldi anchored. And if you were to go through all of our financials and disclosures, you would see that we actually bought it at 2% cap rate, which wouldn't hit that accretive to earnings box that I just said by itself, but it's a redevelopment opportunity. And so that's a great example, and I can use that as an example to answer your question. So we go into that with looking at the opportunity, and we underwrite it on a 10-year basis. And basically, what value can we create with our expertise? And so I believe that Regency has the best national development platform in the business. And of course, I'm going to believe that, as you know, being at the company for 26 years, but there's truly no one else that does what we do from a development standpoint on a national basis. There's a lot of regionally focused, and a lot of our peers, our publicly traded peers, focus only on redevelopment, as you asked about, whereas we do ground up as well. So we'll go into that, we underwrite it, and with this development team, what can we do with this asset? And that example, there's almost a vacant office building also on the property. So we looked at being able to essentially raise that office building and create more retail. We're going to actually connect it to the Stu Leonard's shopping center that we already own, and we're going to upgrade the merchandising. And at the end of the day, with investing real capital, but we believe the IRR that we're going to drive, unlevered IRR, is going to be close to 10%, as a result of our invested capital that we're putting into it with our development expertise. So that's an example. But generally speaking, I heard you say 150 million. Really been pushing our team to grow that and to be very confident in saying we should do 200 million plus. And I do believe that actually differentiates Regency, because when we think about our publicly traded peers that compete for investor capital, we have Kimco is the largest in the sector from an open air shopping center, Regency second, and then you have Brixmor, Federal, Height, and a few others. ROIC out on the West Coast. Again, we all are very similar. We all own institutional quality shopping centers, and our business is one of a balance of stability and sustainable growth. Robin pointed out to the fact that we didn't cut our dividend, and it is because we have long-term leases and people pay us contractual, rent. So our growth isn't, we're not going to compete against Apple or Microsoft or Amazon. We have very slow, steady growth. So we all kind of look a little bit alike, except Regency can differentiate itself through development. And our ability to invest, we generate $130 million of free cash flow. And when we lever that, it gets north of 200 million. If we can invest all of that 200 million in ground up developments or redevelopments at north of 7% return on invested capital, that return is so much greater than what you can buy a shopping center. Well, this is all changing, of course, because the world is changing with rising interest rates. But for the past 10 years, that 7% return on invested capital for developments was 250 basis points wider than what you could buy shopping centers for. And so that was a way for us to really add and enhance our growth rate versus our peers. And as a result, we've outperformed from a shareholder return basis.
When you think about development or redevelopment, is it exclusively retail, or is there some mixed use going on like some of the malls are doing?
Generally, we like to focus on the retail portion, and what we say is our bread and butter. Those tend to, for our core competency, offer the best risk-adjusted returns. But there will be some opportunities where we do have a mix of uses. And when we do that, we typically will partner with an expert in whatever the other use is. So, for example, one close to home for you all, relatively close to home, we started a ShopRite Target anchored shopping center in Old Bridge, New Jersey. And there's going to be a medical office building there. And we are essentially ground leasing that to a medical office developer. In California, for those that are familiar with the Grove, which is one of the most well-known shopping centers in the US, we actually own the Whole Foods across the street from that. It's called Town and Country, and we are redeveloping that and creating and building, moving Whole Foods into a vertical mixed-use building. So it'll be retail on the ground floor with apartments above it. And again, and then we're going to redevelop the existing shopping center with just refreshed retail. The vertical building is ground leased to a multifamily developer, Holland, and we're going to buy back the retail. So that's how we approach mixed use. We did for a period of time what we called lean in, and we leaned into being the developer of the mixed use, and it just wasn't the best use of our human capital or our capital from a risk adjusted return standpoint.
Do you see that as a trend as the areas densify, doing more of that?
Yes, and I think you see that from a lot of our peers, competitors as well. More often than not, it's going to be densifying with multifamily. So again, I can give you another example. We have another one in Bethesda, Maryland, a shopping center called Westbard, where it's a giant anchored shopping center. And we are, again, just redeveloping the entire site and adding multifamily above ground floor retail. So yes, absolutely. And it is a way to really create more value at our existing shopping centers. Yeah. So let me ask about your balance sheet, and then we're going to turn it over to Adam and Gigi for some more. But you have, I believe, the lowest leverage in the sector. Is this because you saw interest rates rising and figured no debt is good debt, or why have you been so conservative? I wish that we were that smart. No crystal ball, but right, we've lived through cycles, and so that it has been a strategy of the company for really since the GFC. We had a lot of lessons learned there, and I think we know that we did let leverage rise to a level that prohibited us from taking advantage of disruption in the marketplace, and also we were forced to cut our dividend. And the lesson learned back in 2009 was that we needed to have a balance sheet for all seasons. And we were one of only 2 REITs in the shopping center that did not cut their dividend. So that really did serve us well. But more importantly, it was when thinking about in times of what may lie ahead in 2023 of capital markets disruption, pricing dislocations, that we wanted to be able to have the ability to capitalize on that and take advantage of those opportunities. And back in 2009, there were so many great opportunities, and we couldn't do anything. We were handcuffed. And so we talk about this all the time. So our net debt to EBITDA is right around 5 times. It is the lowest in the sector. Our strategy is to keep it over the long term between 5 and 5.5 times. So we are certainly on the low end right now. And we love that we're in that position because we have the ability to invest close to $1 billion with all debt. And I just told you we have $1.2 billion in our credit facility. So even if it wasn't available to us from a term loan or a publicly traded bond, we would be able to act. And there's no one else in our sector that can do that today. And that's when we believe that's when you can really kind of take large steps in differentiating yourself. We haven't had those opportunities come to us yet, but we're waiting. And to the extent that we can continue to leave that dry powder, and I think I haven't looked at the stock market today, but generally we've been performing relatively well. We would access the equity markets when it feels like that it's priced appropriately to continue to keep that dry powder available for when it's not.
So what kinds of opportunities do you think might be coming? Over-levered players having to shed assets, or?
Yes, exactly. And that typically comes, so our business, the open air shopping center business, the institutional, it's only about 15% institutionally owned. And I think public companies are probably about 12% of that.
So that little, I hadn't realized.
It's really fragmented. And so you have a lot of, so for example, I'll go back to the Sirota portfolio that we bought in Long Island at the end of 2021. I mean, that was a family-owned portfolio forever. And there were some family dynamics that brought that to market. But there are a lot of private families, family office is what generally it's called. And even some of the institutional pension funds that have life to their, aren't infinite life, that do have leverage that with the rising interest rates, they just simply won't be able to refinance and have the numbers make sense. So it's better to sell it. So those are the types of opportunities. And I go back to 2009, we had one that came to us and it was our own partner. So we had a partnership with Macquarie Countrywide out of Australia. It was they were 75% owner, we were 25% owner. Same, so this and our partnership had all secured mortgages, and they happened to be coming due, right? I think it was 2010 and 11, and Macquarie simply could not afford to refinance them, so had to sell their ownership interest, and it was being offered basically for sale. And this is out of context for some of you all. You may not understand this. But it was being offered for sale at a 9.5 cap rate, which was just insane because we bought it together from a group called First Washington, just like, I think it was 7 years earlier. So it was 7-year debt, maybe even 5 years earlier, 5 and 7-year debt at a 6 cap rate. So that's how much pricing had moved. And Regency did not have the balance sheet to buy them out. We had to actually bring in another partner to buy them out. And so those are the types of opportunities that we think may come and hope may come.
We'll see. Adam, Gigi?
You go ahead if you'd like.
Yeah, I just, if we can go a little bit back to speaking about grocery anchors. And as you mentioned, you guys right now have one of the highest concentrations of grocery anchor properties within the strip center sector. And recently we haven't seen e-grocery national trends rising. And if that continues to accelerate faster than expected, it's going to have an impact in the fundamentals for grocery anchor centers. So my question is, what are Regency projections for the e-grocery sector, and how do you usually go about strategizing in the event that those trends continue to accelerate?
I appreciate the question. We don't believe it's going to continue to accelerate. We think that there's going to continue to be share growth, if you will. It's similar to if you were to go back to the 90s when Walmart first entered the grocery scene, right? They started in the mid 90s, I believe, with less than 2% market share in the grocery business. And they're the largest seller of groceries today. I believe their market share is probably 25%, and they captured it really quickly. And we had, if you were to go back and listen to an investor earnings call in 2018, 2019, you would have heard me, as well as my predecessor, Hap, say that we believed that there was going to continue to be consolidation and rationalization of physical stores as a result of the competition and the growth in e-commerce, that there was going to be a need for fewer stores, not just grocery, but in really all retail categories. But it wasn't going to replace it in whole. And I believe Hap, the prognosticator that he was, that he expected about 25% of stores to close. That hasn't happened, and I think that's probably too high because of what we learned over the past few years during COVID. But even if that did happen, just like when Walmart went from 2 to 25%, think about that. That's a lot of sales that they were taking from others. It's the weaker operators that didn't survive. And the stronger operators, so the ones that already had number one market share and in their where they operated, or the specialty grocers like Whole Foods and Trader Joe's. They were the ones that were able to survive. And we still believe that is going to continue to be the case. And going a little bit off to answer your question, it's why we think Kroger Albertsons is a good thing for the business, because if that merger does go through, it creates a stronger operator to continue to invest back in their business. So yes, we think that e-commerce is going to continue to grow, but not at the rate it did. It was the acceleration happened as a result of COVID and a need, and the actual grocers accelerated their investment and their innovation, and they're kind of all there now. And from even when I opened, they very much recognize that the most profitable way for them, remember, it's a low margin business, really low margin business. And the most profitable way for them to sell their groceries to customers is to bring the customers in the store. Mm-hmm. And the next most is let them at least drive into the parking lot and we'll pull it out to their car. Delivering to the home, not to say that there's not going to be future innovation that may change this, but it's not visible right now. So for the next 10 years, grocers are going to continue to try to invest in their in-store experience to bring people into the store. And that's why you see Amazon, right? It's why they bought Whole Foods. They know it. It's why Amazon is trying to figure out, how do I do this inside four walls? Because a solely digital home delivery model isn't working. It's just, they're not making money on it. Mm-hmm. If we did a really deep dive on new store growth, specifically grocery store growth over the next 5 years, and Amazon actually has the most new stores planned. So if anything, that's validation that a physical store matters.
Yeah, and as a follow up to that question, we do see a lot of. I guess the question is, how is technology impacting the business for your tenants in terms of bringing people into the physical stores? Because, for instance, in the grocery store sector, we see a lot of apps where people still get their home delivered, but you have the person that is going into the store and shopping at the store and then delivering for households. So right. How do you see technology having an impact in the entire sector into bringing people inside the stores?
Yeah, it's a great question. Again, thinking about what we've observed and what our tenants have learned, they have to embrace technology and use technology. And that's even your nail salons, right? I mean, we have to, and I say we, because again, we're partners with our tenants. We have to make it seamless and easy for the consumer. Everyone's so short on time. Everybody's in a hurry. And so regardless of whether you're selling a good or a service, have to embrace technology and use it to, the tenant's advantage, to our advantage, to drive more traffic. And the most successful operators are going to be those that do that the best. But from a business like grocery, it's a little bit more challenging. And I'll give you another example, because I know that you've probably read about Kroger. So Kroger is, I would say, they are the one grocer that they throw a lot of spaghetti against the wall, right? They just do a lot. They do a lot of testing and R&D and trying things. And Ocado is their central distribution robotic facility that started over in the UK, and they invested in it and they brought it over to the US. And it's a big experiment, and the jury's still out whether it's going to actually work and be successful. So for example, they built an Ocado facility. So it is I believe, I forget exactly how much the capital investment is, but it's a lot. And their estimates are that it's got a 3-year payback after it's built. And that hasn't actually, I don't think they've actually met their own estimates. But it's a central distribution facility, completely robotic. So it is leveraging technology inside as well as with the customer, because it's all app driven. And they've got a facility in Orlando. They're servicing, I live in Jacksonville, Florida. They are servicing this market. I see Kroger delivery trucks, and there's not a single Kroger store in the market. But again, that's one that's trying it. I'm not sure that it's working and successful. I did visit their first facility that they opened outside of Cincinnati, Ohio, where their headquarters are. Extremely impressive facility. They still haven't figured out refrigerated goods very well. Haven't figured out frozen goods at all. And the interesting part of it is that that facility does the volume of about 15 stores, and in a 3-hour catchment area is what they call it. They have over 250 stores in that 3-hour catchment areas. So it goes back to the stores aren't going away. And there's going to be continued innovation and really R&D to figure out how best to do it. So on the flip side, I'm still answering your e-commerce question, because we're going to watch it unfold over the next 10 years. Albertsons actually believes the model is micro fulfillment. So what that means is if Albertsons could wave their magic wand, they would love to add 10 to 15,000 square feet at the back of every store they own, and use that with robotics, use that as their picking center. Because like you said, when the people are going in the store to pick for customers that are getting it delivered at home, it's getting in their other customers' way. And you just heard me say that the in-store experience is really important. And so they struggle with these pickers. And so they'd rather have the picking outside of the store. And the last mile delivery is a lot cheaper than the central delivery. So again, it's going to be fun to watch. And we just
they have duplicates of everything at the back of the store for the pickers?
Well, again, this goes back to technology too, right? So the data analytics is going to be such another important part of every retailer, especially grocers. So they know, what do people order at home? So it's not duplicate of everything. There are certain groceries that people are more comfortable ordering to be delivered versus those that they want to go into the store and pick themselves.
That makes sense. I'm still struggling with what the nail salon does technologically. Is that just an appointment system, or?
Yes.
I don't go to any nail salons that don't offer online appointment making.
And
There you
that
go.
wasn't the case 3 years ago. I don't think any of them had it, probably.
Makes sense. So switching topics for a moment, you were the first issuer of green bonds at Regency. Tell us a little bit about that, and more broadly, how you think about ESG, corporate responsibility, et cetera. Yes.
From the time that I joined Regency, I would say it was part of who we were. But we never had a name for it, right? I mean, we're going back to the 90s again. But within 10 years of me joining the company, we did start to have a name for it. And, corporate responsibility, sustainability is really where it started. And in 2007, we actually hired a vice president of sustainability. And we knew that it was the right thing to do. But we also believed that there's a business reason for it, and that it would help us attract capital, have approvals with cities happen more easily, more efficiently, and then also attract talent. And I would say, I think we were early in that journey for the US, maybe not so much for Europe. And so to your point, when we did our green bond, I think it was 2014, because it's actually coming due in 2024. It's our next bond maturity. We were the first REIT. We were only the second US company, period. The only other company that had issued a green bond at that point was Bank of America. So we were certainly on the frontier. And since that time, a lot of people have caught up. And there's been a lot more, and we're trying to stay ahead. But there's so much more focus from everyone for the right reasons. NAREIT, one of our highest priorities. We have 5 core priorities, and facilitating the journey for the real estate industry on the ESG is one of the top ones. So the way Regency thinks about it is we do call it corporate responsibility, but it is E, S, and G, and they're all equally meaningful for, especially the G for a public company. So from the E standpoint, we recently did put out targets that were endorsed by SBTI. Again, I think one of the first to really do that, and that was to reduce our scope 1 and 2 GHG emissions by 28% on an absolute basis by 2030 and a net zero by 2050. So we are committed to it. We think, again, it's the right thing to do. But we also think it is good for business for all the reasons that we thought 14, 15 years ago. Those haven't changed. So we're going to continue to focus on that. And in our business, it's a little bit tougher. We don't control the space like an office company does, the interior. So it's difficult for us to build a LEED certified shopping center because believe it or not, the retailers aren't as advanced as we are, which you think that they would be. They may be maybe in their headquarters office buildings, but not in their individual stores. So the way that we're going to impact that, we've sort of already optimized water conservation. So now we continue to do it through lighting, LED lighting, and then roofs, solar generation. That's really our biggest asset. So that's the E. The G, Regency's been committed to and best in class for as long as I can remember. And so we continue to ensure that we just stay on top of that. As you know, I read the Wachtell reports that come out. It's ever changing. There's always new regulations, but we really do try to stay best in class. The S, I believe, is becoming, it's always been important to us, but I do believe, again, that's becoming as elevated in kind of and in focus as the E has been for quite some time. And especially with regards to DEI and diversity, equity, and inclusion. And again, really important priority for REIT as well as it is for Regency.
You know, Lisa, Robin started off with his doom and gloom, and he mentioned Ukraine and all this other stuff, and you've relentlessly avoided anything that wasn't super optimistic, which is just like so fabulous and refreshing. Is there anything that does keep you up at night?
So it's really interesting because I have been through other cycles, and especially the GFC, right? One of the worst for all real estate, and certainly for Regency and shopping centers. When we went through, when we entered that, so late 08, as we're starting to think about that, we were at a peak in everything, peak occupancy, peak rents. And so there was really nowhere to go but down. And we fell pretty hard, pretty fast. COVID actually made us stronger. And it seems really odd to say that, but we still haven't recovered all of our occupancy. While all those great things have happened, they have, record leasing, record demand, but we're still not back to peak occupancy. So we're actually entering the next, what I do believe is going to be a recession, if we're not already in one, at a level where we have real confidence that we're going to be able to continue to grow through it. Because even if that demand tapers, which I think it will, we don't think it's going to go negative. I think it's just because we still have, it's supply and demand. There hasn't been a lot of new shopping centers built. Again, goes back to why Regency, I think, is a differentiator. So there's not a lot of new supply, and there's not a lot of good quality space. So I think we're going to continue to grow through it. There's a lot of uncertainty, and I remember somebody asked me out in, I think it was one of my peers, a CEO of another publicly traded company, one word, how would you describe how you feel? And I would say uncertain, because I'm confident, but it's still, there's still a lot of uncertainty. But we believe our balance sheet is set. We've got a quality portfolio, and there's still the renewed appreciation for a physical presence from the retailers can't be understated. So the demand that we continue to see, because they know as well, that it's going to be challenging. And real rising costs of capital are going to impact companies' abilities to invest. And that means new stores, but it doesn't mean I don't think they're going to go to zero. So it's uncertain, but we just believe we're as well positioned as we possibly can be, heading into what is going to be a really challenging 12 months. So I am officially NAREIT chair. The NAREIT chair in 2009 was Hap Stein. So Regency has really bad luck, apparently, with regards to who is leading NAREIT in times of what may be a very challenging economic environment.
So, Gigi, I've got the perennial question from the students about opportunities, but have we made it through your list?
Yeah, I just have one more question, and Lisa, I'm sure you get this question a lot, but I'm just wondering, with the current microeconomic conditions and inflation and people having less disposable income, what are you predicting for Black Friday and just holiday shopping in general?
So some of you may not know, I'm also on the board of our local Federal Reserve branch. So I'm on the Jacksonville branch of the Atlanta Fed. And I read a lot, probably even more than most of my peer CEOs would read from an economic information. And I read something this morning that actually troubled me. And it was how much savings is still how much pandemic savings are still left in consumers' accounts, because that's what's happened, right? And that's why we haven't seen the decline in spending. Savings actually rose so much with all the stimulus and with less things to do. And the answer was somewhere between 9 and 12 months, which is just, as a Fed board member, that scares me, because that means that you can continue to raise rates and inflation's gonna, it won't ease. So my guess is, I bet it's going to be pretty strong. It's not going to be negative. I don't think that holiday sales will be negative. They may not be as robustly positive as perhaps once one thought, but I bet you they're still positive overall.
So last question, unfortunately, we're almost out of time, but the question a lot of students want to ask, especially given the uncertainty in the market, is if you were at Schack right now getting ready to enter the world, any particular areas, disciplines you would focus on? You've obviously had an incredible career, but you've stayed at one place for a long time. I think you said 22 years or
26 years. Yeah.
26 years. So you got on the right train, and it worked out well. What train would you get on now?
Oh, that's a good question. So while I have been at Regency for 26, I was only spent 2 years at GE, 2.5 years, and then 2 years at Anderson Consulting. I would say what I've learned is the most important thing is finding, and that's why I've stayed at Regency so long, finding a company that aligns with your values. And the people that you like to go to work with, because it is work, and it's called work for a reason. And
the new generation doesn't understand that.
But when you are surrounded by people that doesn't mean they have to be like you, but that you respect and like, it makes it a lot less like work. And I think that the only other advice I would say is don't be afraid to say yes. And I'm sure that you hear that all the time, Gigi, in your class, right? So you only grow both professionally and personally when you feel uncomfortable. If you're comfortable all the time, you're not growing. And so push yourself and take risks. You have your whole life to be an adult, and find the company that you might stay at for 26 years, but it doesn't have to be the first one. So something that's going to challenge you, aligned with your values, and generally you like the people that you think you're going to be working with.
Well, that sounds like great advice. And I agree with Adam, the optimism here. This is the perfect pre-Thanksgiving session because I'm feeling better. So can't thank you enough, Lisa. Really appreciate.
My pleasure. Thank you. I appreciate y'all having me.